Hello and welcome to this session on the structure and content of financial statements. In this lesson, we will cover the important contents of each of the three financial statements, namely the balance sheet, the income statement, and the cash flow statement. And then we will also look at the structure of each financial statement. As I will show you later, each financial statement can link the contents through a simple equation, and at the end we will see how the three financial statements are linked to each other. Balance sheet is the first financial statement that we are going to get familiar with. The contents of the balance sheet are connected by the equation equity equal assets minus liabilities. Assets are resources that a company owns, and liabilities are creditors' claims on assets. That is what a company owes. So watch these two words. Own is assets and owe is liability. Equity is the owner's claims on assets. So you can see that liabilities are different from equity. Equity is associated with owners or shareholders, and liability refers to the claims of creditors such as lenders and suppliers. The basic accounting equation that many of you may be familiar with is assets equal liability plus equity. And when we restate this, it can be shown as equity equal assets minus liability. Now, this equation has important implications. As you can see, if the liabilities exceed the assets, the equity becomes negative. And that is, of course, bad news for shareholders, but it can also be bad news for creditors such as lenders and banks. So here is a list of typical assets that show in a balance sheet. You can see that cash appears on top and land at the bottom. This is called the order of liquidity, which basically means that assets that are shown at the bottom of the list are more difficult to be converted into cash, and assets near the top of the list can be converted to cash easily. Cash is, of course, the most liquid of all assets. Here is a list of typical liability that appear in a balance sheet. You can see that accounts payable appears on top and long-term loans, etc., appear at the bottom. So what this means is current liabilities, that means liabilities that are due for repayment or payment within 12 months from the date of the balance sheet, appear on top, and long-term liability that can be paid after 12 months from the date of the balance sheet, which could be 13 months or which could be 3 years or 5 years. Long-term liabilities are shown at the bottom of the balance sheet. Now, the equity comprises of two components. One is the paid up share capital, and the other is the retained earnings. So, retained earnings are profits earned by a business but not distributed as dividends and retained within the business for reinvestment. So note very carefully that equity equals share capital, which is the contribution to the share capital by shareholders, plus the retained earnings. In the balance sheet of most companies, the retained earnings is a very big part of the equity. In some countries, the financial statement list includes what is known as the statement of changes in equity, and it describes the changes in equity from the beginning of the year to the end of the year. Income statement. Income statement presents revenues, expenses, and profit. The equation for the income statement is profit equal revenues minus expenses, and revenues are what a business earns by providing goods or services. There are two kinds of revenues broadly. One is sales, which is revenue earned by a business from its core business activities, and the other is known broadly as other income. So, take for example a company that is trading in cement. So, sale of cement will lead to sales. But if this company has some extra cash and puts the money in a deposit in a bank, the interest that it earns would be called other income. Expenses are presented in the income statement following a functional classification. So, manufacturing expenses, also known as cost of goods sold, is the first and usually a big part of the expenses. The selling and general administrative expenses include items such as advertising, marketing, and corporate management expenses. This is followed by interest expenses, and of course, interest expenses will appear in the income statement of only those companies which have borrowings. Companies that don't borrow will not have any interest expenses. And finally, there is taxes on income, and taxes on income are calculated as a percentage of the profits before tax, and these taxes are paid to the government. The third financial statement is cash flow statement. The structure of this financial statement is shown by the equation cash balance equal cash inflows minus cash outflows. So cash flows can be broadly from three sources: operation, investment, and financing. And the operating cash flows are usually from customers and to suppliers. So, business will collect money from customers and pay its various suppliers. Here, suppliers refer to all kinds of suppliers, not just of material, but also of services and employees. Cash flow from investments refer to cash flows that are linked to long-term assets. So, if a company buys long-term asset, it will have a cash outflow on investment, and if it sells long-term assets, it is likely to have a cash inflow on investment. Cash flow from financing are related to lenders and shareholders. So, money received from lenders and shareholders are inflows under this category, and money paid to lenders and shareholders are outflows under this category. So, finally, the three financial statements come together as shown in the picture here. So, first we make the income statement and calculate the profit, and out of this profit, part of it is paid as dividend, and the balance will go to the equity section of the balance sheet. Then we make the cash flow statement, and then the cash inflow minus the cash outflow will add to the cash balance that is there in the company at the beginning of the year, and the total cash balance will move to the asset side of the balance sheet. And the balance sheet will always be balanced by the identity or the equation equity equal assets minus liability. We will build on this knowledge in our subsequent sessions. Thank you very much for your attention.